Financial analysis. It might sound intimidating, like something only Wall Street gurus do, but trust me, it's a superpower anyone can master. Think of it as your financial detective toolkit, helping you uncover the secrets behind a company's success or potential pitfalls. Why is this crucial? Because knowledge is power, especially with your money. Whether you're considering investing in a stock, starting your own business, or just want to understand your personal finances better, financial analysis gives you the insights you need to make smart decisions. It's like looking under the hood of a car before you buy it. You wouldn't buy a car without understanding how the engine works, would you? The same goes for investments. You need to know what makes a company tick before you put your hard-earned money into it. So, buckle up. We're about to embark on a journey to demystify financial analysis and empower you to take control of your financial future. Get ready to become your own financial superhero. Imagine you're a pilot. Before takeoff, you wouldn't dream of flying without checking your instrument panel, right? Those dials and gauges tell you everything about the plane's performance: speed, altitude, fuel level. The same principle applies to understanding a company's financial health. That's where the three major financial statements come in: the income statement, the balance sheet, and the cash flow statement. These are your financial instruments, providing a snapshot of a company's performance over a period of time. The income statement, like a financial diary, tracks a company's revenues and expenses over a specific period, ultimately revealing its net income or loss. Think of it as the profit and loss statement. Next, the balance sheet provides a snapshot of what a company owns, its assets, what it owes, its liabilities, and the difference between the two, equity, at a specific point in time. It's like a financial photograph, capturing a moment in the company's financial life. Finally, the cash flow statement tracks the movement of cash both into and out of a company. It shows how much cash a company generated from its operations, how much it invested, and how much it raised or repaid in financing. Think of it as the company's cash register, recording all cash transactions. Mastering these three statements is like having X-ray vision into a company's financial well-being. Let's start our deep dive with the income statement. Remember, this statement reveals a company's profitability by outlining its revenues and expenses over a specific period. It answers the fundamental question: is this company making money? The first line item you'll typically see is revenue, also known as sales. This represents the total amount of money a company earned from selling its products or services. Think of it as the money coming in the door. Next comes the cost of goods sold, or COGS, which represents the direct costs associated with producing those goods or services. For a manufacturing company, this might include raw materials and labor. For a retailer, it would be the cost of the products they purchased for resale. The difference between revenue and COGS is gross profit, which tells you how efficiently a company generates profit from its core operations. A higher gross profit margin generally indicates greater efficiency and profitability. Now, let's turn our attention to the balance sheet. This statement provides a snapshot of a company's assets, liabilities, and equity at a specific point in time, giving you a glimpse into its financial health. Think of it like this: assets are what the company owns, its resources, possessions, and investments. This includes items like cash, accounts receivable, money owed by customers, inventory, property, plant, and equipment, or PP&E. Liabilities represent what the company owes to others, its debts and obligations. This includes accounts payable, money owed to suppliers, salaries payable, and long-term debt. Equity is the difference between assets and liabilities, representing the owner's stake in the company. It's what's left over for the shareholders after all debts are paid. The balance sheet follows the fundamental accounting equation: assets equals liabilities plus equity. This equation highlights that a company's assets are financed either by borrowing money, liabilities, or by using owner's investments, equity. Section 5. Tracking the lifeblood. Analyzing the cash flow statement. The final piece of our financial puzzle is the cash flow statement, which tracks the movement of cash both into and out of a company over a specific period. It's like following the trail of money, providing a clear picture of a company's liquidity and its ability to generate cash. The cash flow statement is divided into 3 sections. This section shows the cash flow from the company's core business operations, the cash generated from selling products or services, minus the cash used to run the business. This section tracks cash flows related to investments made by the company. This includes purchases and sales of long-term assets like property, plant, and equipment, as well as investments in other companies. This section shows the cash flow from activities related to raising and repaying capital. This includes issuing or repurchasing stock, taking on or repaying debt, and paying dividends to shareholders. Understanding a company's cash flow is critical because it reveals whether the company has enough cash on hand to meet its short-term obligations and invest in its future growth. Section 6. Ratio Analysis. Uncovering the hidden stories in numbers. Now that we've explored the 3 major financial statements, let's delve into the world of financial ratios. Ratios are powerful tools that allow you to compare a company's financial performance to its past performance, to its competitors, and even to the industry average. Think of ratios as financial clues, helping you unlock hidden insights and make more informed investment decisions. Here are some key categories of financial ratios. Measure a company's ability to meet its short-term obligations. Examples include the current ratio and the quick ratio. Assess a company's ability to generate profits from its operations. Examples include gross profit margin, operating profit margin, and net profit margin. Measure a company's reliance on debt financing. Examples include the debt-to-equity ratio and the debt-to-asset ratio. Measure how effectively a company uses its assets to generate revenue. Examples include inventory turnover and asset turnover. By analyzing these ratios, you can gain a deeper understanding of a company's financial strengths and weaknesses, its risk profile, and its overall performance relative to its peers. Section 7. Beyond Numbers. The power of qualitative factors. While financial statements and ratios are essential for assessing a company's financial health, they don't tell the whole story. Qualitative factors, such as the quality of a company's management team, its competitive landscape, and industry trends, are equally important in understanding its long-term prospects. Here are a few key qualitative factors to consider. A strong, experienced management team with a proven track record of success can be a significant asset to a company. Look for leaders with vision, integrity, and a commitment to shareholder value. Analyze the company's competitive position within its industry. Does it have a sustainable competitive advantage? Is it operating in a growing or shrinking market? Identify the key trends shaping the company's industry. Are there any technological advancements, regulatory changes, or shifts in consumer behavior that could impact its future performance? By considering both quantitative and qualitative factors, you can develop a more holistic view of a company's investment potential. Section 8. Putting it all together. Making informed investment decisions. Now that you've learned the fundamentals of financial analysis, it's time to put your knowledge into practice. Remember, the goal of financial analysis is to make more informed investment decisions. Here are some key steps to follow. 1. What are you hoping to achieve with your investments? Are you looking for growth, income, or a combination of both? 1. Research different companies or investment opportunities that align with your investment goals. 1. Carefully review the company's income statement, balance sheet, and cash flow statement. Calculate key financial ratios and compare them to industry averages and competitors. 1. Assess the quality of the company's management team, its competitive position, and industry trends. 1. Based on your analysis, determine whether the investment aligns with your risk tolerance and has the potential to meet your investment goals. Remember, investing involves risk. Past performance is not indicative of future results. Diversifying your portfolio across different asset classes and industries can help mitigate risk. Section 9. Your journey to financial mastery. Congratulations! You've taken the first step towards mastering financial analysis. Remember, this is a journey, not a destination. The more you learn and practice, the more confident you'll become in making informed financial decisions. Here are some resources to continue your education. The Intelligent Investor by Benjamin Graham. Security Analysis by Benjamin Graham and David Dodd. One Up on Wall Street by Peter Lynch. Investopedia, Morningstar, Yahoo Finance. Many online and offline courses are available on financial analysis, from beginner to advanced levels. Don't be afraid to ask questions, seek guidance from financial professionals, and continue to expand your knowledge. Remember, the power to achieve your financial goals lies within you. Start your journey to financial mastery today.